Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Ackerman, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. He's speaking to us from South Florida. Welcome back to the show, Rick.
Thanks for having me on, Jim. It's always a pleasure.
Rick, is there a danger when the market is so boring like it is today that people get complacent and they take their eye off the ball? They think things can only keep kind of creeping up, or if there is a little down moment, it's not going to last for long and it's going to just keep on marching higher, and that's when you get caught holding the bag.
Yeah, I mean, there is a danger on a day like today that if you watch it too closely, you'll die of cardiac arrest. This market could barely fog a mirror, and you tend to think, just because nothing's happening today, that when you extract that out in a linear way, nothing is going to happen. And that's kind of hard to believe. The market is it's in a position of, I guess you could call stasis within some awesomely tense, poles. It's getting pulled in different directions, but today it just happens to be at rest.
When it's in a situation like that, are there any warning bells that go off in your head?
I wish, for me, the closest I can get to a warning bell is that sometime in the January-February period, I put out targets for all of the major averages, for the ones that my guys follow. The diamonds, for one, industrial average, E-mini S&Ps, the Qs, IWM, the NASDAQ, and virtually every one of them is still in what feels like a topping pattern that in some cases was within hundreds of a percent of the target that I gave. So all these things hit what were pretty significant targets. And even though the odds are never with you when you say, hey, I think this is the top, when you're talking about a bull market that just entered its 13th year. So the odds are never with you for picking a top, but I have to go on that assumption right now simply because everything hit my target and the targets have not been exceeded over the last 5 or 6 weeks.
Where is the money coming from to keep this market afloat?
Well, that's a fascinating question because, when you get to these levels, it takes a lot of money to push a stock like Amazon from, 3,000 to 3,200. That's a lot of money per share. So, by and large, you can see where there are several sources of money. One is that companies, even the ones with tens of billions of dollars socked away, that they have no clue what to do with it. Well, that doesn't stop them from going out and borrowing more for next to nothing to buy back their own shares. So that's one source of buying. And I think the perceptions of a U.S. recovery being stronger than anywhere else but China, feeds their global, sources of money that are flowing into the U.S. It's not simply a monthly accretion of pension money or whatever. There are other things that are pushing the market higher, but you have to wonder really, even at that, where it all comes from, because at these prices, it's very expensive. Keeping Google afloat at $2,000 a share, Chipotle $1,400 and change. So these aren't little guys, and they're certainly not Robinhood and Reddit guys that are doing the buying. It's the big money.
We'll have more with Rick Ackerman right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Rick Ackerman. Rick, do you see another run at shorting silver to boost the price?
No, I think that the Reddit, I guess I'm not going to call it a threat, but they said they had such success with GameStop and Hertz and a few others that they figured why not go after silver. And I think there was something to admire in that, because there was a perception out there among our youngsters that nothing is more hideously manipulated than the bullion markets. So they made the mistake of thinking that they're manipulated in the same way that let's say GameStop is, and that short positions in bullion are the same as a short position in some of these story stocks. But of course that's not the case, you know. In bullion, you almost have two distinct markets where people can be clamoring, they can be lined up at the coin shop doors, trying to buy bags of junk silver or bullion ingots. But at the level of the global markets and the markets that are essentially tended to by bullion bankers, where gold loans are the source of great income, it's a whole different, it's an entirely different animal. So I think our youngsters confuse the two, and they put a pretty good spike into silver. And I think that silver is still kind of digesting it, you know, for just a few days back there in late January, early February, silver exploded. And otherwise, I think the chart would be more similar to gold's. But right now, it looks like silver is showing greater relative strength, and it's only because for a short while silver got pushed higher. But that said, you know, we've got the COMEX May contract trading right now at about $25.29, and the bullish pattern that's influencing it has a target up at 34.55. So nothing has happened really to that target's still viable and will remain so. Silver would have to dip below $22 an ounce to negate the bullish pattern, which goes back to last June.
Now, somebody once told me it would be a good plan to secure your future to buy a couple ounces of silver every month because it's relatively cheap, and at some point it's going to explode. Is that any advice that you would take?
Well, no one's lost money on that, other than when I remember going into Trader Sam's in San Francisco, walking out with 2 bags of junk, silver for, I can't remember what the price, it could have been, it was a lot of money. And then after silver peaked with the, Bunky Hunt episode where he tried to corner silver prices, it peaked at $50 an ounce and came down really hard. I remember taking my bags of junk back to Trader Sam and coming away with about, 20 or 25% of what I paid for them initially. But other than that, I mean, silver's been good. It's a little bit different from what you want to teach your children, which is about the miracle of compound interest and how if they sock something, money away in something that pays interest, that it continues to compound over their lives, and it's been demonstrated many times how no strategy beats that. But we're in times really where it's hard to find anything that with a yield that's not hugely overbought. You might have had your kid buy Nevada Light and Power or something like that years and years ago, but it's harder to find those stocks. So, but I think they could do worse really than having a program to buy regularly gold and silver. In fact, I had a business with a couple other guys where we put a fortune into a website, but that was the idea of it, that we would, it was a coin, a non-numismatic, gold and silver coin auction. And we had a few pages for the kiddies just to encourage them, in this idea of just buying a little bit of silver or maybe a very small amount of gold each month. But I would certainly, my kids have effectively done that, although I did the saving for them. I put away gold, silver, and platinum coins, and I gave them to them a few years ago, and I'm sort of surprised that they've held on to them. They're both in their 20s, and you can see they might think, oh, this would be a great chance to cash out some coins and buy a Ford Mustang or something like that. But they both kind of taken a rainy day approach, and they've held on to their coins. But it was a nice surprise for me that they feel that way about savings.
We'll have more with Rick Ackerman right after this.
Ackerman Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Ackerman's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at ackermanresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Rick Ackerman. Rick, with low interest rates, is there any way to save for a rainy day like your sons appear to be doing?
Well, it's harder. And, my sons are in sort of an odd situation. One flips Supras, which is a high-performance Toyota from the 1990s that's become very collectible. And he says, I say keep a lean inventory because you don't know what a bear market does to a market overnight. He says, oh, I know where to I can unload these cars. He carries anywhere from 5 to 12 of them at any given time. And he says, yeah, I could sell all these just in a few days, that he knows where the buyers are. But he hasn't experienced a bear market where literally overnight the liquidity completely dries up. But as far as accumulating anything, when you see how much difficulty Warren Buffett's having doing that, I'm not quite sure what he's in, but he famously came out of some things such as Apple, and even companies that you believe in, anything you believe in, has been bought to death. The story's been sold to death. So these are really hard times to sock away something that will give you good growth, without the downside risk of some speculative stocks. So, even so, I guess, some fund that specializes in treasuries, T-notes, long-term treasuries, that might not be a bad way to go, because in general, and also in the interview that we did last week, my idea was to simply go into things that everybody hates, which mainly right now would be bullion and bonds.
Going back to bonds, what are they doing, and are they controllable by the Fed? I know the Fed is trying to do yield control for long-term products, but really, is their only influence short-term rates? They can't really project themselves 10 or 30 years into the future.
Well, they can't, but they have had sway over the whole, the yield curve from short to long term. But there is a suspicion that they may be losing control right now, because as bond prices, treasuries have come down, yields have gone up. And right now, the yield on a 10-year is 1.64%, And you and I talked about this, but from a technical standpoint, I think yields started to go out of control on the 10-year, which is to say all yields, when they rose above 1.26%. So they're way above that right now, and if the current trend keeps going, I think we could see just a tad over 2% on the 10-year. That's, I'm using a pattern on a daily chart to project that target. And you better believe there's going to be some soul searching if we get a push in yields up to there and a corresponding strengthening of the dollar, because virtually not only is no one prepared for that, but everybody is essentially on the other side of the bet. So yields are becoming a little bit problematic, especially, with Powell out there saying, we're not even going to think about, tightening anywhere, anytime. He doesn't even use the word tightening. He just says we'll stay the course at least till 2024. So, he's, I think at this point, nervously looking over his shoulder here, at rates that are starting to respond to perceptions of impending inflation. And of course, the only thing Powell can do is say, it's not really there. Don't trust your lying eyes. And, and he's made something really of if you can call this a change of policy, I guess he's more explicitly managing our expectations or the psychology of inflation, as though that hasn't been the Fed's game all along. So I didn't quite understand his last little talk, but I don't feel badly about that because no one else did.
Well, our market historian Bob Hoy has pointed out that since the Fed was invented on Jekyll Island in 1913, there have been 18 official recessions. They haven't called this a recession yet. That would be number 19. The Fed was supposed to be able to prevent recessions and depressions, yet we've had so many. Why would it be different this time? Could they again prevent a major recession / depression?
Well, it's very different this time because the top tier earners are all, they're getting it from capital gains. And at the level of the working stiff, we are in something like a depression. There have been so many jobs lost. There have been so many opportunities as the small businesses are really dying everywhere. It was hard enough to compete before the pandemic, but now with the big guys in there just trying to consolidate their monopoly hold on so many areas, especially retail and even in the food business. So it's just an odd, when we talk about recession, it depends on who you are. And if you're in the certainly in the 2%, you're not feeling any recession at all. You're feeling the benefits of an asset inflation. But, it's not, one other thing we talked about last week in the interview concerning deflation was that everybody's kind of fudging the definition of inflation. They talk about it nowadays as though it were the wage push inflation that happened in the 1970s. And even when we talk about fear of inflation, and the Fed at some point was not as lucid as it is now, saying, we don't want to let a runaway inflation happen. Well, the real concern was not inflation, but it was, but deflation. So I'd like to know, when the monetarists or economists talk about inflation, what they have in mind, because to me, this is an asset inflation, and it seems like win-win all around. But it's not like the 70s inflation, when you have an asset inflation, it's tantamount to a bubble. It's not an inflation that just goes and goes. It's an inflation that goes until it pops. So it's such a radically different inflation that we're experiencing now. And yet nowhere, even when when all the imbeciles who run the Federal Reserve talk about it, they don't give you very good definitions of what kind of inflation we should fear. Because again, the asset inflation we're having is the one that everybody should love and that they do love.
Well, back in the 90s, both the U.S. and Canada agreed to change the official definition of inflation. They took out housing and they took out the price of energy, saying they were too volatile to really keep track of accurately, so we're just going to toss them out of the equation. So, all of a sudden, even though the price of a house had gone up 20% in 1 year, that didn't count. And so your wages were, quote, the price of inflation. Okay, you get a raise this year of 2%. But my house costs 20% more to buy. My car costs 15% more to fuel up. Well, that doesn't count. So somehow, and food costs are connected to fuel costs because you have to grow it, harvest it, ship it, but that's excluded from the cost. So, the government has been fudging the numbers since the 90s. How can we know that we're not living in a time of rampant inflation? Because my wife definitely tells me our grocery bills are much, much higher than they used to be. The condo fees have gone up because of high insurance costs and also the cost of natural gas for warming up things like the swimming pool.
Well, you're right. Wages have certainly not kept up with that, so that in our daily lives, we don't need statistics to tell us whether inflation is raging or not. You know, you can just feel it when you pay the bills. And so collectively, we've all gotten squeezed. And broadly speaking, we've all made up the difference by borrowing more and more and more, so that you finally have people buying more car than they can afford on 7-year, payment plans. They lease cars instead of buying them. So the system has continued to adjust in order not only to make it easier for people to borrow, but for more and more people who are ill qualified to borrow. We don't want to exclude them either. So that's really it. The shortfall between wages and rising prices has been made up by increasingly by debt. And, as far as all the things that the major things that we measure, when we talk about GDP and inflation, nobody knows, really. You can't really even measure that stuff. GDP is such a complex, set of numbers that who knows what GDP is really. It's kind of a fiction that it tells us anything, because it really doesn't. So in theory, we would have a better idea of what's going on, not measuring GDP or inflation, but we would have other metrics if interest rates were doing their job. Interest rates would be the signal that our borrowing is productive, that it's, we're producing, each dollar that we borrow produces more than $1 in growth. And we're way below that metric now. But, we long ago short-circuited the interest rate mechanism to tell us what our money is doing for us, what the effect of debt is. So, I don't see, the only way you can really get back to honest numbers is to have a good old-fashioned, stock market crash and a second Great Depression. I think we'll come out of that a lot more honest than we are now, but nothing short of that is going to put us back on track.
Is there sort of a 40-10-40 split in America where you have 40% are in the upper income bracket and they've done okay through this whole thing because they're managers, doctors, or people in the healthcare industry, which has been very busy, or working as a pharmaceutical salesman. And then the middle part where that's just being totally hammered because the middle class really functions on small business, and small businesses have been wiped out. And then the bottom 40 are the people who worked in those small businesses, and they've been wiped out. So is America really a 40-10-40 split?
I don't know what the percentage break is, but the bulk of prosperity in America comes from small businesses, and so many of them have been eliminated that you can sense that we're not really in a very healthy state right now. Certainly not robust enough to repay anything close to the borrowing we have done to achieve a supposed stimulus, and it hasn't really stimulated much economically. It's just stimulated asset inflation. So I don't think there's an easy way to get beyond that. We're going to have to see. We're all going to have to pay a price, really, to be re-educated to the fact that there's no free lunch.
Somebody has argued that there really is no reason to pay taxes. You have governments shoveling billions, in the case of the U.S., trillions of dollars out the door. The government still functions. Employees for the government are paid. They're still paving roads. So if they can do that right now, why do you have to pay them any money anyway?
Well, that's a very interesting question, because nothing would stimulate. You can imagine. I mean, if you want to stimulate the way we're stimulating, which is screw investment, let's just get a lot of consumption. Nothing could be more stimulative than an announcement that, hey, we're going to have a moratorium on income taxes in 2022. I mean, can you imagine what sort of pent-up forces that would unleash? We'd all be driving Lamborghinis, but we've stopped short of that. Even though by the time you add up a couple, $2 trillion stimulus package here and a $3 trillion stimulus package there, by the time you put a few of those together, you get to thinking, well, hell, why don't we just say no taxes in the year 2023?
Why don't we do that? I think that's a terrific way to pull your socks up and get out of recession, because the most constant bill you get is the tax man. And if you think you own your own home, your mortgage is done, don't pay your civic taxes for a year, and guess what happens to your house? Yeah,
I mean, it's what we're doing anyway, but we're putting off the borrowing component. It would make it so obvious if we had that announcement. It said, look, no taxes in 2023. Go out and party. And boy, would we ever. We're doing that right now, except we're on the layaway plan. And so the layaway plan sort of obfuscates the free lunch aspect of it. We seem to be able to borrow now without limit, and there's no real cost. But I think that it would be dramatically more obvious that there is a cost if we said, the powers that be say, look, no taxes in 2023. Everybody would say, well, how does that actually work? But for sure, it would get a lot of votes.
Well, okay, eliminate income tax, but you'd still have the sales tax, and if the economy's booming, there would be a lot of sales made.
Yeah, I mean, you can always tax one way or the other. They've talked about a value-added tax like they have in Europe for so long. But I think the reason it hasn't made much headway is because there hasn't been enough talk about which taxes would be eliminated. Most people have the idea, and I think it's a correct idea, that a value-added tax would be on top of all the taxes we're already paying. It's not like saying, hey, we're going to bring in a value-added tax now, and we're going to reduce the marginal the rates in each bracket. So the way it's debated, though, is this revenue neutral or not? Will the government come out ahead or behind? And they talk about that as though somebody really cares about deficits. So we've already thrown any caution concerning deficits to the wind, and maybe the time really has come for a 1-year tax moratorium.
Yeah. Well, okay. Run for Congress, run for Senate, run for president. I'm sure you get elected on that platform.
I wonder. I mean, it feels like a good populist winner to me, but. Well, yeah,
although, I wouldn't want to live in, the Prime Minister's residence or the White House because you have all these servants and officials running around. You have absolutely no privacy. And, frankly, I like being able to just walk around in my underwear.
Yeah, that's true. I think they do too. They do too. Although you can't, I guess even in the White House, you got to keep your gym shorts on.
Oh yeah, I was going to say they probably wear a tie with their pajamas. They don't want to make a bad appearance in front of the employees.
Uh-huh.
Rick, always fun.
Well,
yeah.
Indeed, it has been a pleasure, Jim. I always enjoy our conversations.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He was speaking to us from South Florida. If you have any questions for Rick or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.